You're listening to The Intellectual Investor, episode number 146. I Kid You Not Crazy, written by Vitaliy Katzenelson and read by Elliot. To read this article online or to listen to more episodes, visit investor.fm. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. I Kid You Not Crazy. We all played this game when we were kids. You say a number. Your friend tries to demonstrate his knowledge by saying a bigger number. At some point, you proudly get to infinity, the largest number of all. Your friend doesn't blink. He says, infinity times 100. Then he thinks for a second and spouts out, infinity times infinity. How do you beat that? When assets get overvalued and get into crazy territory, explaining their overvaluation feels like playing this infinity times infinity game. But at least, if we line up different crazy valuations next to each other, it is going to be easier to distinguish levels of craziness. Let's start with the least crazy of all the crazies, bond substitute type stocks. In this example, I'll focus on Coca-Cola, but I could have written this about almost any consumer goods company, the likes of Kimberly-Clark, McCormick, WD-40, and many others that pay a stable dividend. Coca-Cola has been spreading joy and diabetes globally since 1886. It is truly an incredible business. The company makes a concentrate and ships it to bottlers, who put in the hard capital, bottle that syrup, and distribute it to every corner of the world. Coke, in concert with its bottlers, has the best distribution system in the world. Since bottlers do all the heavy lifting, this business earns a very high return on capital. Coke is one of the most beloved brands in the world, unless you are a Pepsi person. This company has experienced incredible growth over the last century. However, unless Coke gets penguins at the South Pole to consume its fine bubbly, it has run out of new markets to sell into. This is exactly what has happened to Coke since 2010. Its revenues and earnings have stagnated. If you look at its financials, only two things have grown: its dividend, due to an increased dividend payout, and its debt, which has tripled. Coke is a high-quality company. It can raise prices along with inflation on its namesake product, which is about half of its revenue. It may struggle to do this on other more commoditized parts of its product portfolio, but nobody questions whether Coca-Cola will be around in 10 or 20 years. Most importantly, investors are convinced Coke will continue to manufacture its 2.6% dividend till the end of time. They are so focused on the shiny object, the dividend, that they are ignoring how much they are paying for this seemingly endless income stream. Mr. Market will let you have Coke today at 30 times earnings. But what happens to Coke's stock price if interest rates dare to go up? Coke's 2.6% infinite dividend will not be so shiny when interest rates go up a few percentage points. If the 10-year Treasury is yielding 5%, Coke's dividend will lose its luster, and the stock will decline to a valuation multiple with a 1 in front of it. Today, many Coke shareholders are experiencing what behavioral economists call empathy gap. They tell themselves, I am fine even if the stock declines 30 to 50%. I will stick with getting my 2.6% dividend, which will rise with inflation. However, when the stock price declines and safe alternatives offer double the yield, they'll change their thinking, thus the gap. Side note, dividends don't need to be a shiny object that lead you to eventual financial ruin if and when interest rates rise. Just change the sequence of your analysis. Here is what we do at IMA in dividend portfolios. We identify the universe of stocks in the US and other countries that pay stable dividends, but only the ones that are both high quality and undervalued end up going into the portfolio. Coke is a lightweight on the crazy spectrum. The degree of crazy will increase with each further example, culminating with smelly, hot air. I promise. The next one is Tesla. I've spilled a lot of ink on this company. I even wrote a series of essays that turned into a small book that you can find at a link in the show notes. I love my Model 3. Almost 3 years after I bought it, I still enjoy driving it, and I'm not even a car guy. We are about to get my wife a Tesla. I like a lot of things about the company. But The stock is a very different matter. An important lesson that many tech investors learned after the bursting of the dot-com 1.0 bubble in 1999 and the dot-com 2.0 bubble in 2021 is that there is a difference between a good company with great products and a good stock. The connecting tissue between the two is valuation. The price you pay determines your future return. The price did not matter when valuations were rising. It will when they aren't. Tesla arguably has the best EV on the market. Customers love its product. This is not a little thing. Unlike the Detroit 3, the German 3, and the Asian 5, which spends tens of billions on advertising, Tesla has zero advertising budget. Hundreds of thousands of its fanatically loyal customers are its marketing force. Most car companies don't have that type of goodwill. These billions of dollars of savings Tesla can put into more R&D or lower prices or higher profitability. But Tesla has a market capitalization of $1 trillion, or roughly equivalent to what the whole rest of the global auto industry is worth. When it was at $500 billion, half an infinity ago, I described its valuation as discounting a temporal wormhole into the future. Today, it is priced at double infinity. Let's move on to the next level of crazy. Gamestop is in the hands of self-described apes that are standing for the little man against the corrupt system and are willing to blow themselves up financially while propping up the prices of worthless companies. GameStop is a retailer of packaged games while the world is moving to digital downloads, a tsunami that is going to wash away this brick-and-mortar retailer. At its peak in 2016, the company made $400 million profit. Its revenue has declined by half since, and it's losing money. The apes are pricing this dying relic at a $10 billion market cap. Its valuation is almost at an all-time high, when its financial situation is at an all-time low. Imagine you won a $10 billion lottery. Would you invest in an imminently melting, money-losing ice cube whose revenues will eventually dwindle to zero? GameStop makes Tesla look like a value investment. At least Tesla is a company of the future. Of course, there is another ape stock, AMC, the movie theater chain. AMC has often lost money throughout its existence. Before the pandemic, it made $110 million. Its revenues are down by 2/3 since then, while its share count is up 4 times and debt is up 5 times. Today, after the stock has declined by 50%, you can have this darling for only $11 billion, and it comes with $10 billion of debt. At least GameStop has a net cash balance sheet. Then, there is the crypto universe insanity. I've spilled a ton of ink on Bitcoin in the past, but I'd like to point out again that there are thousands of competing cryptocurrencies fighting for dominance. For Bitcoin maximalists, Bitcoin is their only lord and savior, and all other cryptos are heretics. Many, however, believe that Bitcoin is an inferior crypto Stone Age type of technology, and that new, technologically advanced alternatives are better, thus the thousands of cryptocurrencies. As I am typing this, it dawns on me that arguments about which cryptocurrency is superior are not unlike medieval debates about which religion is better. We all know which one. Unlike religious debates and ensuing wars, the crypto debate will end quite peacefully, with people losing money. Since cryptos have no cash flows, I have no idea what their value is. However, considering that prices of all speculative assets have skyrocketed recently, just look around you. My gut sense tells me that the price of cryptos today reflects an overabundance of both optimism and easy money. But then we have a whole new level of crazy: NFTs, or non-fungible tokens. You put a drawing of a flying monkey or a happy goat on a blockchain, and you have got priceless, finite, non-fungible art. NFTs of apes that happen to be bored are selling for hundreds of thousands of dollars. My son Jonah, a student at CU Boulder, told me that many of his friends are making money in NFTs. And most importantly, they're bragging about it. They have suddenly become connoisseurs of digital art. Jonah tells me about the latest and greatest NFT. Ozzy Osbourne of Black Sabbath fame recently decided to become a crypto artist and will drop only 9,500 drawings of bats, which Ozzy calls crypto bats. To get Ozzy's art at wholesale price, you must go on his discussion board and tell the world how much you love it. If you do this enough, then board moderators may let you buy it at wholesale, so you can flip it to an even greater fool at retail, who'll try to flip to another even greater fool for a higher price after he brags about how much money he made on NFTs, which are our digital future. Jonah asked me, "Dad, is that not by definition a pyramid scheme?" I am a proud parent. As I am typing this, I have caught myself wanting to say, every other sentence, "I kid you not." So maybe we're approaching the pinnacle of crazy. When I discuss Coke, its overvaluation is not an abstract concept, it is quantifiable in brushstroke terms. Even Tesla's overvaluation is not entirely abstract. You are paying more for a company that produces 1 million cars a year than the rest of the industry that produces 40 to 50 times more cars. Everything beyond that, from Gamestop and AMC to cryptos and NFTs, might easily be worthless, and thus quickly turns into an abstract discussion. How much will Ozzy's crypto bats be worth when the last college kid blows his tuition on them? I have an answer for you. 0. When 0 is priced in relation $300 or $30,000, it is overpriced by infinity. In either case, the loss is 100%. Actually, in many cases, the loss will be greater than that. What we learned from previous bubbles is that greed and FOMO eats people from the inside and causes them to resort to leverage. Leverage ruins people's lives, and it has never been easier to borrow money than it is today. Sadly, a lot of people who are beating their chests and bragging about how much money they are minting today will lose their temporary gains and a whole lot more. The ultimate prize for crazy goes to Stephanie Matto. Actually, not to her, but the people who spent $200,000 buying her farts in a jar. Stephanie had to make a personal sacrifice in order to produce them, resorting to an unhealthy, gas-producing diet. She had a mild health scare and decided to quit. But don't worry, I kid you not, she is now making NFTs. Thank you for listening. This and other investment articles by Vitaliy Katzenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaliy's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.